Investing in startups, what millionaires look for in a deal. Hello and welcome back to High Net Worth Living. If you're watching this video, you're likely interested in learning how the wealthy approach startup investing. It's true, startups offer immense potential, but they also come with high risks. The millionaires and savvy investors who make fortunes in this space don't rely on luck. They look for specific qualities, conduct thorough due diligence, and always have an exit strategy. Today, we'll break down what millionaires look for when investing in startups, covering everything from the team behind the company to market demand, business model, and competitive advantages. By the end, you'll have a toolkit of strategies to evaluate startups like a pro. Let's dive in. Why startups attract millionaire investors. Investing in startups can be risky, but for millionaires, the potential for outsized returns often justifies the gamble. When you invest in an early-stage startup, you're getting in before major growth, often before revenue streams are fully developed, and sometimes even before the product is completely built. That means that, if the company succeeds, the payoff can be significant, sometimes 10x or even 100x the original investment. Additionally, investing in startups allows high net worth individuals to diversify beyond traditional assets like stocks and bonds. Many millionaires are also drawn to the sense of contributing to innovation, building communities, and supporting products that might change the way we live. Key traits millionaires look for in a startup. Millionaire investors typically start with 4 major factors when evaluating startups. Behind every successful startup is a strong, visionary team. Millionaires look for founders who possess deep expertise in their industry and resilience to handle the ups and downs of entrepreneurship. They often seek founders with a track record of success or relevant experience in a similar industry. Investors want to see a cohesive team that shares a common goal and can work together under pressure. A great team can only go so far if the market isn't there. Millionaires are often drawn to startups targeting large, scalable markets. Ideally, they look for markets worth at least $1 billion or that have significant growth potential, because even a small market share in a large market can lead to massive revenues. They also want to see evidence of customer demand and that the market is ripe for innovation. Millionaires want startups with a product or service that solves a real problem. They look for businesses with validated proof of concept, whether through initial sales, beta testers, or even a prototype. This shows that the product fits market needs. When there's a clear product market fit, it's easier for the startup to gain traction quickly. A strong startup needs a unique selling proposition or some competitive edge. This might include patents, proprietary technology, a strong brand, or strategic partnerships. Millionaire investors want to know what will make this startup outlast or outperform the competition. Financial metrics and projections. Now let's talk numbers. Millionaire investors look closely at financial metrics, even for early-stage startups. Here are some key areas they analyze: revenue and revenue growth. They assess any existing revenue and, most importantly, the revenue growth rate. Even if the company isn't profitable, showing revenue momentum indicates that customers are interested. Burn rate and cash flow. Millionaire investors also look at how quickly the startup is spending money. A high burn rate without a clear plan for generating income can be a red flag. They want to see disciplined spending and efficient cash management. Gross margin and profitability potential. For early-stage startups, profitability isn't always immediate, but having a clear path to profitability matters. A strong gross margin indicates that the business could potentially reach profitability in the future, given the right market conditions. Projected financials. Millionaires scrutinize financial projections to ensure they're realistic. Overly ambitious revenue projections are usually a turn-off unless there's solid evidence to support them. They want startups with balanced, well-researched projections. Due diligence is one of the most important steps in investing, and millionaire investors take it very seriously. This process involves verifying the company's claims about their product, market size, competition, and finances. They'll often review legal documents, intellectual property, company structure, and customer contracts, if available. The goal is to uncover any potential red flags, such as legal issues, unmanageable debt, or exaggerated claims. This rigorous process can take weeks or even months. It's not uncommon for millionaires to bring in advisors or consult with experts to ensure they're making a sound investment decision. Valuation and negotiation. Valuation is critical because it impacts the investor's potential returns. High net worth individuals are cautious not to overpay, as an inflated valuation makes it harder to see a profitable exit down the line. Millionaires typically evaluate comparable companies and weigh the startup's current stage against its growth potential. Negotiation is another critical step, where investors might request certain terms to reduce their risk. For instance, they might ask for preferred stock, which gives them priority in repayment if the company is sold. Millionaires also seek influence in decision-making by requesting board seats or observer rights. Exit strategy. Every investment needs a clear exit strategy. Millionaire investors look for startups that have a defined path to a liquidity event, such as an acquisition, merger, or IPO. They need to know that there's a way to recoup their investment, ideally with a solid return. While this may be 5 or more years down the line, they want to be confident that the startup has the potential to generate a profitable exit. To wrap things up, millionaires invest in startups by focusing on the strength of the founding team, the size of the market, product market fit, and the startup's competitive edge. They look closely at financials, conduct thorough due diligence, and establish a realistic valuation before sealing the deal. And, importantly, they always have an exit strategy in mind. If you're considering investing in startups, adopting these strategies can help you make informed decisions and better understand the balance of risk and reward. Remember, startup investing isn't a get-rich-quick strategy, it's about careful planning, patience, and finding companies that align with your goals and risk tolerance. Thanks for watching. If you enjoyed this video, don't forget to hit the like button, subscribe, and let us know your thoughts in the comments below. Until next time, happy investing!